Are you a UK limited company director? If so, these are the common mistakes to avoid, even if you've got an accountant. Firstly, mixing personal and business expenses. This is a really common one and crops up all of the time. Often this can happen inadvertently. You might walk into a shop and rather than paying for something on your personal debit card or credit card, you use your business debit card or credit card. The implication then is that personal expense crops up in your business bank account, which then causes problems because then we've got, when the accountants are looking at it, they've got to then decide what is business and what is personal. Okay, so that's the first thing to be careful of. The second one is just make sure you have got a dedicated business bank account. Most limited companies do have a dedicated business bank account, but again, we do have some where people are mixing business and personal transactions in their personal account as well. So keep those two accounts separate and just be careful how you spend within those accounts. The second area is paying yourself incorrectly. So often with a limited company, you'll take a salary and you'll take dividends out of the business. And what we see very often is people take too much dividends out. So effectively they draw out of their company account too much money, too much personal funds out of their business account. And the implication of that is if there's not enough post-tax profit in your business and you've taken that money out, you've then effectively taken a dividend illegally, okay? And that's got quite severe consequences for the business. So just be really careful. You need to look at your profitability in your business, how much profit you've made, and that's after tax, how much profit you've made, and then you can draw that dividend out of post-tax profit. Third area, which we quite often see, is around directors' loans and confusions on directors' loans. So if you borrow money from your company, you're effectively taking a director's loan. And these are quite common, but they do need to be managed carefully. The implication of taking a director's loan is if that loan is outstanding for more than 9 months after your company's year end, then there is a tax charge on it, and it's called an S455 tax. And the tax rate on that currently is 33.75%, which is a big figure, which is quite a punitive amount to pay over. The tax on a director's loan is quite unique in the sense that if the director's loan is then repaid, then that S455 tax can be reclaimed back from the government. But you do have to be careful with director's loans because there is tax implications of taking them. The other issue around director's loans is interest. There is interest if you don't pay interest on your director's loan at the market rate or the HMRC minimum rate, you will be liable for a benefit in kind on that loan as well. So director's loans are a real sort of area that do need to be carefully managed. And we would take advice from your accountant because again we do see people in a real sort of pickle with their director's loans. The third area that we see is late filing. So what we always try and do is give our clients plenty of time to make their filings. So this might be filing their accounts, filing their corporation tax, filing their confirmation statement. But frequently, these things can get missed and they get behind. Now, it is the director's legal responsibility to ensure that the filings for their company are made on time. If they're not made on time, the implication is that there's potentially going to be fines, there's going to be penalties. If it's tax, there could be interest to pay. So there's a whole myriad of things that if these fines aren't made on time, then happen to your business, which then can cost you an awful lot of money to get sorted out. The final area is this assumption that don't worry, my accountant is on top of it. We see this when we pick up clients. Is like, don't worry, my accountant used to handle that. And just be really careful that you've got the responsibilities, things that you're going to take responsibility for as a company director, and what your accountant is going to take responsibility for. Just make sure that they are really well documented. You've got a very clear engagement letter with your accountant, which quite clearly lists what they're going to do. And what you're going to do, and therefore there should be no ambiguity around responsibilities of who's doing what. Unfortunately, this sometimes is not the case. There is ambiguity. This assumption by directors that don't worry, my accountant is covering all of that. Frankly, in some cases they're not. So that responsibility, has got to be very, very clearly defined. If you're experiencing some of these issues or experiencing some of these problems, then please do get in touch, and we can help you through.